This session is about the economic reforms since 1990s. Meaning of economic reforms. Economic reform usually refers to deregulation or at times to reduction in the size of government to remove distortions caused by regulations or the presence of government rather than new or increased regulation or government programs to reduce distortions caused by market failure. So, why we need of economic reforms in India can be explained below. So, we need economic reforms for increase in fiscal deficit, increase in adverse balance of payment, Gulf crisis, fall in foreign exchange reserve, rise in prices, poor performance of public sector, terms and conditions of World Banks. So, these are the some causes for which we need economic reforms in India. So, there are some types of economic reforms which can be explained as follows. The first type of economic reform is structural reform initiatives. Second one, fiscal reforms. Third one, infrastructure reforms. Fourth one, capital and money market reforms. So the main features of economic reforms have been categorized in three parts. So the main features of economic reforms are liberalization, privatization and globalization. So LPG are the main features of economic reforms. So first of all, privatization. Simply speaking, privatization means permitting the private sector to set up industries which were previously reserved for the public sector. Steps taken for privatization are sale of share, second one, disinvestment in PSUs, that is public sector undertakings, third one, minimization of public sector. Number of industries reserved for public sector was reduced from 17 to 4, and the transport and railway, mining of atomic minerals, atomic energy and defense equipments. These are the four industries which have been there in the public sector, and the remaining 17 industries have been removed from the public sector and given to the private sector. The next one is globalization. Globalization means the establishment of relations of the economy with world economy in regard to foreign investment, foreign trade, production and financial matters. Steps taken for globalization are reduction in tariffs, long-term trade policy, partial convertibility, increase in equity limit of foreign investment. The third part is liberalization. Liberalization means to free to economy from the controls imposed by the government. Before 1991, government had put many types of controls on Indian economy. These were as follows. The first control was industrial licensing system, second one foreign exchange control, third one price control on goods, fourth one import licenses. So these under the liberalization, these controls have been removed. Steps taken for liberalization have been discussed with the following points. The first point is independent determination of interest rate. Second one, increase in the investment limit of the small scale industries. Third one, freedom to import capital goods. Fourth one, freedom to import technical know-how. Fifth one, freedom for expansion and production to industries. Sixth one, freedom for monopolies act. Seventh one, removal of industrial licensing and re-registration. These are the some steps taken for the liberalization. The next part of this session is effect of liberalization on Indian economy. So there are some positive effects and some negative effects of liberalization on Indian economy. First of all, positive effects of liberalization have been discussed as follows. The first positive effect is growth rate of per capita income. Second one, growth rate of real GDP. Third one, change in structure of the economy. Fourth one, growth of average saving rate. Fifth one, improvement in capital utilization. Sixth one, incidence of poverty has been reduced. Seventh one, business income more customers focus. Eighth one, growth of industrial sector. Ninth, growth rate of SSI's production. Tenth one, impact on employment. 11th one, growth of foreign trade. 12th, technological impact. 13, improvement in India's external position. 14, investments in Indian industries. So these are the some positive effects of liberalization on Indian economy. The next part is the negative effects of liberalization. So like the positive effects, there are some negative effects of the liberalization on Indian economy. These effects are: first one, impact on Indian companies; second one, structural transformation; third one, downward growth; fourth one, current account deficit; fifth one, more demanding customers; sixth one, reduced profit of Indian companies; seventh one, consumer price index; eighth one, unfavorable development; ninth one, reversal capital inflows. So these are the some negative effects of the liberalization on Indian economy. This session has been referred from some books called Indian Economy written by RYK and Indian Economy written by KD Baswa. Some internet sources have also been preferred for the reference. Thank you.